We've had it established that Deutsche Bank does see the case for a hike coming from the RBA in August. So what would that mean at the coalface for the housing market, for lending demand? Anthony Landahl from Equilibria Finance joins me now. Hi,
Good
how
morning.
are you? Okay, does your spidey sense tell us that we're in for another interest rate hike?
Yeah, it was interesting listening to your last guest. I think it's becoming fairly consistent now amongst the economists that there's a very good chance of a rate rise. I think everyone's waiting for that quarterly inflation data, but yeah, I think we're looking at a 25-point basis rise in August. The RBA doesn't really have a lot of choice with these core inflation numbers that came out in May, and then obviously we got the critical stuff, the quarterly data in June.
Yep, okay, so we will be watching out for that quarterly data. What will happen to, let's start with owner-occupiers, to the demand for housing in that sector if we start to see, another interest rate hike?
We've seen a resilient market, as we know. The market's grown about 8% over the last 12 months. That's on the back of a drop previously of about 7.5%. So we're back above where we were, but we are starting to see a bit of a slowdown. June quarter this year, growth was about 1.8%. Last year it was around 3.3%. So we are starting to see these rates bite. Savings buffers have been eaten into, redraw buffers have been eaten into. Savings ratios have gone down from about 11% to about 1% now of household income. So people are starting to hit those thresholds, I guess, around their cost of living and repayments. The average mortgage now for an $800,000 loan is about $4,000 a month. So another rate rise is going to, I think, start hitting demand. We're seeing a bit of a slowdown. People have been factoring in potentially a rate fall, but I think now with the commentary, we might see a slowdown on the demand side for owner-occupiers, and we're starting to already see that with what happened in the June quarter.
Mm-hmm. Okay, and what about investors?
Yeah, look, investors are another story. We're seeing a lot of investors coming back into the market over the last 12 months, albeit the main consideration to a certain extent at the moment with the investors is around the cash flow. So obviously the cost of debt is quite high. A lot of investors are running properties where they're cash flow negative, so they're having to top up their funds. So we may see a little bit of an impact on investors, but we are seeing a swing of first home buyers also buying their first property now as an investor. So we're getting some new players into the market as investors. So I think we'll probably see the owner-occupiers maybe hit a little bit harder than investors, with investors more looking at their shorter term cash flow. But also if the market does fall a little bit and prices soften, investors are going to find some opportunities there as well.
Yeah, but even when we have been in this interest rate hike cycle, I mean, we always talk about when or if there's price softening. We really haven't seen that. We
haven't. We've had a situation of increased cost of debt, affordability constraints, and housing prices rise. From Jan 2023, we had 5 interest rate hikes, and we've had housing prices rise back above record levels of May 22. Yeah. So it's a difficult market to pick. That's really on the back of supply and demand mismatch. Even in June, we had 127,000 houses sold and only 125,000 listed. So supply's been constrained by people haven't been forced to sell, construction hasn't kept up, record migration numbers are keeping that housing market buoyant. But we are starting to see some signs of it slowing a little bit. That does tend to happen in winter anyway. Mm-hmm. So we'll see whether, an interest rate rise, affordability constraints beyond just the housing market, start actually seeing the market slow a little bit.
So on the supply side, I mean, we did have building approvals data out yesterday, but we've got big promises being made by a bunch of governments, that they're going to be building all of these homes. Like, are you seeing any of that come to fruition?
Look, the approvals data in one sense showed the extent of the problem. We've seen approvals increase in areas like Western Australia and South Australia, probably on the back of some of those more affordable states. But in the key states, which is about 50% of the market, New South Wales and in Victoria, approvals are down. We've had 161,000 approvals over the last 12 months. The government's claiming to build 240,000 homes. Here's an interesting one for you. I saw a statistic that for the government to reach its target, a new house has to be built every 2 minutes. So we're a long way off that with current migration rates and flows of construction. We're well off hitting that, and I think it's unachievable. And the main markets, as the recent data showed in Sydney and Victoria, construction approvals are actually weakening.
Mm-hmm. It's a vexed issue, to say the least. Now, I know that you've got a foot in the big smoke here in Sydney and also in the regions as well. Do you see any big difference between what's happening in the two in terms of demand?
Yeah, we've seen the growth in the capital cities has been stronger, but what we've seen in the regions is the growth has actually held up. There was a lot of talk that the regions after COVID might struggle, but a lot of people are still now seeing those regions, particularly the commutable areas, as more affordable. People are happy to commute a couple of days a week to get to their job, and affordability constraints are to a certain extent forcing people into some of those regional areas. In fact, some recent research showed that 19 or so of the top 50 regional areas were experiencing record growth. So we are seeing demand hold up in the regions for those sort of reasons around affordability. Change in how people are living and working is also meaning that those sort of options are more legitimate and more possible for people now. So the regional growth's a little bit slower than the major capitals, but it has held up stronger than people may have thought after the pandemic.